Hello friends. Uh, Today I want to touch on a very sensitive topic, which is about uh, the current situation, the current reality of the markets. I will try to answer most of the questions to the best of my knowledge, and I hope if I am wrong, then you will forgive me for that. But let us see how do we progress. Okay, so let's begin. So first slide is bull and bear. So we often hear about the bulls, the bull market and the bear market and etc. But these are the term, these are the terms coined by stock markets. What is reality? In reality, there is a economic growth or a recession. So what is the economic growth? In economic growth context, let's create a small example of a biscuit. Okay, so there are farmers, they are growing wheat, so their is produced. Now after that they sell the wheat to say FCI or some companies or some APMC market. So from that APMC market, some biscuit manufacturer buys that wheat, he grinds it, creates biscuits, packs them. So now this manufacturer sells these biscuits to the first level of a state level distributor. Okay, then the state level distributor redistributes in a smaller quantities to a district level distributor. Then from district level distributor, it goes to a small dealer, and then on a maybe a kasba level or a taluka level, and then from there, from the dealer it goes to a retailer, and the retailer sells it to a farmer or sells it into a village or a city or somewhere. Okay, so the person who is buying these biscuits, he, let's say he's either a farmer or a working class person, so he actually creates either some food produce, some agricultural produce, or he offers some service, or he is working in some other industry from where he is offering a service and earning some money out of it. Okay, so this is how the whole cycle works. So this is called the whole economic cycle. So in this case, when government has printed some money and the money is being distributed, the money gets distributed to all the people in the society, all the way from the topmost to the bottommost, from the rich to the poor. That is the whole idea, and the money keeps circulating, so either by sales of service or by sales of goods. Okay, so when when this money base is rising, is growing and growing and growing, we call it an economic growth. So when we say that the GDP is increasing by 8% per annum or 9% per annum, or we need 16 or 12% per annum, etc., what we are trying to say is, we are trying to say that we are quantifying, I'm saying again, we are quantifying the economic cycle in mathematical terms. Okay, so that quantification, if the quantification is positive, that means we are in economic boom. If the quantification is negative, or if the quantification is less than the expectation, then we are in a recession. So in case of recession, what happens is the money supply does not go to each and every part of the society. It stops at certain level, and it does not go past to the next level, to the people who are needy and who are poor. So that's how the problem happens. Like in case of recession, if let's say it is the same example of a biscuit, then in that case of recession, because there are the people, the purchaser does not have enough money, so he does not buy the same product, he buys some substandard product. So automatically the demand is reduced, and then the dealer goes out of the business because there is no demand, so he does not want to buy biscuits from the taluka level distributor. Now the taluka level distributor has a better financial capacity than the local level dealer, so what he does is he changes to the substandard product, and then the district level distributor and the state level distributor and the manufacturer, and then everybody changes to a different spectrum, everybody changes to substandard product or to the low quality products which are getting sold. So that's how now there is an economic change. So now the same products which were earlier getting used to sell, at a very good price, now they are getting sold at a very cheaper price, so everybody gets lesser margin, so everybody's expectations are reduced. So that is one way we can say there is a recession. Okay. Now let's go to the next, which is the bull market. So this bull market and bear market are the terms which are quantified by the stock markets. Okay, these are not the economic book definitions, these are terms. So bull market means the prices are rising, but what definition I have give you is half definition. It does not mean the prices are rising only. The bull market means the prices are rising and the transaction volumes are following the prices. So if the prices are going high and the transaction volumes are going along with it, then that means it is a bull market. That means every part of the society is contributing into the rise of the price. If the prices are just rising and the volume goes up little bit and goes down and the prices are still rising, that means now it is only an expectation. There is actually no real volume which is being traded. So in bull market, in other words, you can say that you expected say 10% return. Okay, or let's take a real example that as per my understanding, as per my study, I have found that the market has been giving a compounded annual growth rate, which is CAGR, about 10 to 12% if you would have invested somewhere in 2000 to 2004. So in a 10 or 15 year basis, you get a CAGR of somewhere about 12%. So if so now my expectation is 12%. So if the markets continue to go 12% per annum for next 4-5 years, I will say that this is a bull market. But if my expectation is now 12%, but my actual growth in the portfolio or my investment for next 4-5% in real terms happens only 6% or 8%. So I am gaining lesser than my expectations. So that's why it is a bear market. Okay. Now what is the now we have talked or discussed, or yeah, we have understood about two different terms, which is one is the economic growth or recession and the second is the bull and the bear market. Now we want to marry both of them. So what we are trying to say, why we project from the stock market is, stock market represents 4% of the whole economy. So that means there are 96% other businesses which are not stock market listed. That does not mean that they are not investable ideas. They could be an investable ideas, but that's not the topic today. So what we are trying to say that stock market is a pulse of the economy. Okay. So I will give you an example in medical terms. So let's say you go to the doctor, you tell the doctor that doctor, actually I am feeling very high sweat and feeling exhausted and breathless and etc. Doctor checks your pulse and tells you no, your pulse is fine. There should not be a problem. But you say no, but last 2-3 days I am really experiencing very exhaustive and I'm hardly having the good thoughts and all. So the doctor says, okay, let's do one thing, let's do your ECG or we will do your scan. So now what you have done, now we have talked about two different things. First is he checked your pulse. So this is the markets we have checked. So the markets say everything is fine, everything is good. But when you do actually the ECG or when you do a full scan, you come to know which part of your body is giving you such bad indication. So either is it the problem with the heart, or is it the problem with your breathing or any other organ, or etc, whatever it could be. I'm not going to get into medical. So that is how we decide. So we are not able to see a complete picture of the economy. We are seeing only the markets and we are trying to say that markets are equal to economy. No, that's not entirely right. Okay. So next, go to the next slide. So what are the recent activities that has happened for economy as in? So one is the quantitative easing. You will hear about this come more about from the US markets, or if you will listen to the US channels or something, or any news related to the US. So what is quantitative easing? Quantitative easing in simple terms, that the government has distributed lots of bonds. against which the government is paying an yearly interest to the bondholders. Okay, so what the government says is, okay, right now there is not enough money with the people to continue with the economic cycle. So what we will do is, whichever the bonds which are closer to expiry, we will purchase them all back, and we will repay the deposit to those bondholders. So that way the cash will go to the bondholders, and then the bondholders will start spending the money, and then the system will start going around again. Okay, the definition of quantitative easing could be even greater, could be even deeper. I'm just trying to make it as easy as possible, which is what I understood. So that is how the government purchases the bonds and pays the cash against the bonds. Okay, so that is, in other words, you increase the liquidity into the system. So what is the expectation of the government? That okay, I have printed so many notes, I have paid so much money to my old bondholders against those bonds, and now I expect those bondholders to to spend this money and increase the economic cycle and let all the businesses earn and grow. Okay, but what happens in reality is that the money does not go to all parts of the society. The money stops somewhere in between, and it gets diverted to some other locations, such as it may go to stock market, or it may go to currency market, or it may go to gold market or something, and then you suddenly see that the gold markets are rising and the currency markets are rising, and etc. So the money is not reaching to all parts of the society. Now I will justify my statement with these two charts. Okay, so on the left, yeah, on your right side you will see the FII DII activity, wherein if you will see that in the last 2 years there is a lots and lots of the highest activity happening in the stock market. The FII has sold a lot during December to April 2020, and the DII has purchased. So the red is the DII and blue is the FII. Then after the Trump and the US government declared two packages, somewhere about equivalent to $3 trillion. So then we suddenly see a lot of purchase by FII into our stock markets. Equivalently, the DIIs closed their position and they got out. So now again you will see that the DII are buying in India and the FII is selling a little bit. This is what is happening currently. This data is dated all the way from 2007 up to 2021. Okay, so what we are saying is, if you will see the volumes of this activity, they have not crossed 20,000. They have hardly crossed at some instance 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Up to December 2020, 11 or 12 times only this volume has the investor volume. The positive side hardly crossed 20,000 crore. After December 2019, it has suddenly showing the spikes. Okay, now let's go to the next chart. This is about the FII activity in equity and debt market. So all this activity of the FII is happening on which side, whether is it happening in debt or in equity. So let's see that. So in this case you can see the blue is the equity transactions, the red is the debt transaction. Okay, and then there is a trend line for equity which is in blue, and trend line for debt which is in red. You can hardly see that line, I'm sorry for that. So what I did is I have mentioned the formula above and below. So if you will see from Jan 2006, okay, the FII equity and debt activity up to Jan 2021, which is almost 15 years. So again you can see that hardly there has been an instance when there are a handful of instances when the amount has crossed 20,000 crore. 20,000 crore of investment in equity or debt, or 20,000 crore of exit from debt or equity market from India. Okay, in July 13 there has been a big release of the FII has removed somewhere about 20,000 crore worth of debt from Indian markets, and now suddenly from July or December 2019, we see a sudden action in these two markets by FII. Okay, so I will just try to quantify this in mathematics, in a simple mathematics. So if you will see the equity formula, the slope of the line is 23,000 and the intercept is negative. So the slope is positive. So that means there is a positive activity happening into the equity side. Now if you will see the debt formula, the slope of the line is negative. So it means that the FII are not investing very much into the debt side. So the FII are investing only where they can easily get out of the market. They are investing on the basis of their ease of access, not on the basis of the requirement of the system or the requirement of the situation. So everyone here is looking only for the opportunity and how quickly they can cash it out. Nobody is interested here to stay long or stay further and really help the economy. Okay. So next is, this is the chart for markets, volumes and activity. So you can see this is the chart of Nifty in the monthly basis. Okay, and this is all the way from 2012. You can see the volumes below here, and you can see the monthly bars of Nifty going up and down everywhere. And this is the FII-DII activity all the way from April 2013 to December 20 only, because I'm talking only about this particular part of the Nifty chart. I'm only going to talk about this part. I'm not going to discuss the whole FII-DII activity again. Okay, so if you will see somewhere by 2016 or something, the stock markets fell for some reason, demonetization or something, and then they rise back. So what we saw during that time is that 7,000 Nifty is a very strong support. The Nifty has never crossed 7,000 again. Okay, so this was in 2016 and this is in 2020, where the low was 7,588 or something. So it did not go below 7,000. Alright. So now if you will see from 2016 all the way up, or 2013 for that matter, the markets rallied from here to here, from 7,000 to some number of 9,000 before 2016. So let's see the FII-DII activity from 13 to November 17, which could be somewhere, yeah, somewhere here. You can see that the movement is again not crossing 20,000 crores up or down. Now then after that, if you will see, after December 2016, the stock market prices kept on increasing, but you can see that the volume did not increase much. The volume has been stable. As a matter of fact, there have been 3 months, 4 months in a row where there has been lots and lots of selling, but the price is still going up. Now came the March 2020 and the markets corrected heavily. So what I'm trying to say, that there is a triple top pattern here. This was the first, second, third, or maybe the fourth top, not a triple, four top. So the markets rallied from 7,000 to 9,000 once. They broke that resistance. They went to the next level, 11,000. They corrected a little bit. There was no change in the volume very much. Then 11,000 to 11,200, then corrected, not much change in the volume. 11,300 something to 12,300, not much change in the volume. You can see a big green candles here in volume. So here there has been a very high purchase. So let's see that who did that purchase. So you can see that in that most of the cases, the FII sold out and the DII bought the same position. You getting my point? Here the investors were trapped on the basis of some assumptions that the markets are going to go up and etc., the economy is booming. In reality, the FII removed the money and DII bought same positions. So let's speak about what is the current scenario. we are expecting a 16% or a 22% annual growth CAGR in Indian stock market. Whether can it happen in reality? Our expectation is completely rubbish in this case, because if the GDP is not growing more than 8%, then how can you expect economic if the economic growth is not more than 8% per annum, how can you expect a stock market growth of 22% or something? So in reality, today, as on today, the US GDP is 22 trillion and the US market cap is 200% of the GDP, which is $44 trillion. India GDP is 2.6 trillion and Indian market cap is 3.5 trillion. So what are we trying to say here? That the money in circulation within India is $2.6 trillion and the expected money from the stock market is $3.5 trillion, which is only 4% of the economy. So if the 4% of the economy is $3.5 trillion, then 100% is 35 trillion. That does not make any sense. You cannot have more money flowing into the stock market than they have printed or the money in the circulation. So it clearly tells you that the money is not reaching to each and every corner of this country, to each and every person. Now this is the supporting chart for my claim or for my statement. This is the situation of US 5000 shares with the GDP ratio taken from this, or some people call it a Buffett indicator. I will glorify it. Okay, so this is the fact. In 2000 there was a tech boom in US, so the stock market capital went from 100 to 150%. Okay, so it was about, yeah, it was 1.5 times the US GDP. Then the tech boom, the tech became the bust and it came down to 100. Then in 2007-8, the global financial crisis, it hardly went above 100%, but when it crashed, it just took everything down to 90% or something. Oh no, to 50%. The stock markets were valued at 50% of the GDP. So this was the perfect time to enter. This was the time to enter. Now if you will see, when the markets, US markets crossed again 100% of 100% market cap above the GDP, it was somewhere here, which was in 2012 or 13. So it took 5 years for the US markets to create the market cap equivalent to GDP. So one way you can say that it was a bear market. Okay. So after 2013, 2015, the markets always, the market cap always stayed above 100%, and currently it is super high, 200%. Makes no sense. Now if you will see in here, this is the data published by World Bank, market capitalization of listed domestic companies all over the globe in terms of percentage of the GDP. So let us see. So this is somewhere in 1995 where the market cap to the GDP went to 120%. Okay, 120%, and then corrected back by 2002 or something to 70%, then rose again to 120%, then corrected back to 60% or something. This was 2008, and now then it was steadily rising. So when it crossed the 100%, it crossed the 100% successfully somewhere in 2019 or something, and now in 2020 the market cap of the whole globe with the world GDP is 140% above, so 1.4 times above the world GDP. So we are really seriously looking for a market crash. We are seriously looking for some economic big time change. So if you are really looking forward for investing right now about some exorbitant amounts like 20 lakhs or 30 lakhs, the market is going up, आप 50 लाख रुपया लगाओ 2 दिन में 1 करोड़ हो जाएगा. That is total utter bullish. That is total utter bullshit. Okay, if you want to invest somewhere about 10 lakhs or something right now in the market, I would rather recommend you that do one thing, invest only 3 lakhs, put 7 lakhs into bonds, earn the interest. If next year you see that you earn better amount, your investment has grown as somewhere about 6% in 1 year, you invest the interest you earned on the bonds. For next 4 or 5 years, watch the market, watch your investment very carefully. So at any instance of time the market's correct, your maximum loss is the original capital of 3 lakhs plus the interest you have invested. So it will never cross 10 lakh rupees. If you invest 10 lakh rupees today into the markets because they are going up and you are trying to time the market that I will exit at this point and I will exit at that point, it is not going to happen. It is just going to eat everything that you have earned in the lifetime and you will be doomed. So don't do this. Better is invest only 3 lakhs or 2 lakhs. See how that investment works in the next year. Reinvest the interest you have earned on the bonds. Do this for 3-4 years. Invest only in 4 or 5 stocks. Okay, 4 or 5 who are the index leaders. I'm clarifying it. Invest only 4 or 5 stocks who are clear-cut index leaders. Only the leaders, only the top companies of that particular index or that particular sector. Okay, and then in that case, if you want to invest in next year, top up your position with the interest you have earned on the bonds. Another year, top up. Another year, top up. Do this for 4 or 5 years. You will have a good base created, a good platform, a good structure for your building. After 5 years, you can see that your investments are giving you more than a handsome profit. Then in that case, you can get out of your bond in step-by-step phase-wise manner, and then you play around with your money. You will make more money. But for first 5 years, create a big good platform which is rock solid. Okay. If you really had a problem understanding what I was saying, watch this video in a 0.5x so you can easily understand, or you will have to watch it 3-4 times, because those who are not used to with the jargons, or those who are not used to with these terms, or those who are not used to with economics or basics, they really will have a hard time understanding. Don't go with the news which are published and the articles which are written and anyone is saying anything. Always give a benefit of doubt to everyone, because it is your money. Once you lose it, only you will be responsible for it. If you gain double amount of the money, the brokers are responsible for your growth. If you lose 50%, it is purely your luck. Purely you are responsible for your lost money. It cannot be recovered. So don't do that. Okay. So I will end it here and let me know how do you find it. Thank you.